All right, let's dive deep into the Indian stock market. We're going off of this newsletter from Volatility Coaches of India, dated January 5th, 2025. So pretty recent stuff. But it's packed with like all this data and all this advice. And I think it'll be interesting to kind of like pick it apart with you.
Yeah.
And see like what we can really understand from what they're saying.
Yeah. I mean, what's really interesting about this is it kind of gives us a glimpse into how a professional analyst would approach the Indian market.
Exactly, yeah.
So it's going to be really cool to sort of dissect that and understand it.
Yeah, it's like we're peeking into their playbook a little bit. So they're talking about the Nifty Y50, which is like India's benchmark index. It's hovering above 24,000, dipped a little bit. But the newsletter still paints a picture of like resilience. So I guess I'm curious, when you look at the PE and PB ratios, what are those telling us about the market's current valuation?
Yeah, so the PE ratio for the Nifty Y50 is currently around 22.12. And this suggests that, the market is pricing in future growth expectations. So it's not just about where the market is today, it's also about where investors believe it's going to be in the future.
Okay. So, I mean, is that a good sign then? Or is it like, I don't know, are these expectations justified, I guess?
Well, that's the key question, isn't it? I mean, we need to look at a variety of factors. The current economic landscape, what factors could potentially push that ratio higher or lower, and whether or not those expectations are actually realistic.
Right, yeah, makes sense. So what about the PB ratio? It's at about 3.58, which to me seems to indicate investor confidence.
Yeah.
But is it too optimistic?
It suggests that investors are anticipating strong future growth. But again, it's a matter of whether or not that optimism is aligned with the actual economic indicators and the potential risks that are on the horizon.
Okay. That makes a lot of sense. It's like a puzzle, isn't it? Where you have all these pieces and you kind of have to see like how they fit together. So they're talking about how the Nifty Y50 might be like holding steady, but they point out that smaller cap indices are actually showing like more positive performance. What's the story there?
Well, it's an interesting contrast, isn't it? Because the Nifty Y50 represents, the large, well-established companies. But the performance of those smaller cap indices suggests a different narrative. It could indicate that investors are looking beyond just those big players and maybe betting on the growth potential of these smaller companies, which, of course, inherently carry more risk.
Yeah. So this difference in performance could be an opportunity for investors who are, I guess, a bit more comfortable with risk.
Yeah, potentially. Yeah. I mean, it's a question of whether this is a sign of confidence in the long-term potential of the Indian economy or just, maybe a short-term blip.
Yeah, that's a good point because, they do seem to kind of be sending mixed signals about the short-term versus the long-term outlook, right?
Yes,
They're saying like positive always in the long term, but then they also sort of hint at potential negative trends in the short term. So how do we reconcile these seemingly contradictory outlooks?
Well, I think a lot of it comes down to understanding investment horizons, right? And how different factors influence market sentiment in those different time frames. So like short-term market movements. Those are often driven by news, speculation, even just like general investor mood, which can be very volatile. But long-term trends, those tend to be more grounded in like economic fundamentals, like corporate earnings, overall economic growth. So it's almost like you're trying to read two different maps at the same time. One for the immediate terrain and then one for your long-range destination.
Oh, that's a great analogy. Yeah. So I guess the path that you choose would depend on like your personal investment goals.
Exactly. Like if you're investing for retirement, decades down the road, those short-term fluctuations are less significant than that long-term growth potential. But if you're saving for a shorter-term goal, like a down payment on a house, you might need to pay a lot closer attention to, those short-term market swings.
Makes sense. So it's all about aligning your investment strategy with your time horizon and like your risk tolerance. Now, speaking of long-term outlooks, the newsletter mentions this intriguing thing about the Buffett indicator, suggesting a 6.2% annual return for the Indian stock market. I'm intrigued.
Yeah.
What is that?
So the Buffett indicator is basically, it compares a country's total stock market capitalization to its GDP. And it's a very broad, long-term indicator. It's not about predicting exact short-term movements. It's more about gauging the overall market valuation relative to the economy.
Okay, so it's not like a crystal ball.
Yeah.
But more like a long-range weather forecast. So 6.2, is that something to like get excited about, or is that just kind of like, meh?
Well, I mean, it's important to remember that 6.2%, it's not like a guaranteed return. It's a projection.
Right.
Based on historical trends and kind of current economic assumptions.
Hmm.
So the question is, does that potential return align with your personal financial goals and the level of risk you're willing to take on?
Okay. So we got to put it in context, but how do they come up with that 6.2% number? Like, what went to that calculation?
So they break it down into 3 key components: projected economic growth, dividend yield, and what's called valuation reversion.
Okay.
So economic growth refers to how fast the Indian economy is expected to expand in the coming years, while dividend yield represents the average percentage of a company's share price that it pays out in dividends.
Okay. So it's not just some random number like pulled out of thin air. There's a methodology to it. But what is valuation reversion?
Yeah. So valuation reversion basically means that markets tend to move towards their long-term average valuations over time.
Okay.
So it's the idea that
Right.
what goes up must come down and vice versa. So if the market is currently considered overvalued or undervalued, it's expected to eventually revert back to a more kind of normal level.
Right, like a pendulum.
Yeah.
Swinging back and forth. But how do we know what that normal level is?
Right.
And how does that factor into that 6.2% projection?
Well, that's where things get a little tricky, because determining the fair value of the market is a bit subjective, right? It depends on various factors, including economic conditions, interest rates, even investor sentiment.
Yeah.
So that 6.2% projection likely incorporates assumptions about how all of those factors will play out in the long run.
Okay, so it's more of an educated guess than like a precise prediction.
Exactly. And that's why it's so crucial to not blindly trust any single projection. The Buffett indicator is a useful tool, but it's essential to consider other factors as well.
Okay.
Like government policies, global economic conditions, industry-specific trends.
Right. It's all about gathering that information.
From multiple sources, right?
Analyzing that data.
Yeah.
And forming your own conclusions. Now, speaking of information, this newsletter doesn't shy away from giving some pretty specific investment tips. It mentions things like converting debt to equity below certain RMFTY levels. And focusing on particular sectors. What are your thoughts on that? Should we be taking notes and like rushing to adjust our portfolios?
Well, hold on a second. While it can be tempting to follow specific investment advice, it's crucial to remember that this is just one perspective, right? It's important to do your own research, assess your risk tolerance, consider your individual financial goals before making any decisions.
Okay, so don't just blindly follow the crowd. Think for yourself. But I am curious about the logic behind some of those tips. Like, why would they suggest favoring large cap and momentum funds?
Sure.
In the current market conditions.
Right. So in a potentially volatile market, large cap companies, those with the largest market capitalization, are often perceived as being more stable and less risky. They tend to weather those economic storms better than smaller companies. For momentum funds, those invest in stocks that are already exhibiting strong upward price trends, aiming to kind of ride that wave of momentum.
Oh, okay. So it's about playing it safe, but still trying to capture those potential gains. But wouldn't that potentially, like, limit the upside as well? And are momentum funds always, like, a reliable bet?
Right. That's where the debate comes in. I mean, while large cap and momentum strategies have their merits, they also come with their own risks and limitations. So, it's like I was saying before, there's no one-size-fits-all approach to investing.
Right. It's all about finding that right balance between risk and reward. Now, before we get too deep into specific investment strategies, I want to kind of zoom out and talk about the bigger picture. The Indian stock market doesn't exist in a vacuum. So what are some of those global factors that could be influencing market trends right now?
Yeah, that's a great point. I mean, we need to consider that global context. So global inflation is still a concern, and rising interest rates in many countries could have a ripple effect on emerging markets like India.
Right.
Geopolitical events, conflicts, trade tensions, all of these things can add to market uncertainty.
Yeah.
And then let's not forget the ongoing energy transition, which is creating both opportunities and challenges for different sectors of the economy.
Yeah, it's all connected, right? It's like a giant, like, interconnected web. And even if we just focus on the Indian market, we can't ignore what's happening in the rest of the world.
Exactly.
Oh, and I just noticed something else in the newsletter. They mentioned the VIX being slightly up from the previous week. Now, I always think of the VIX as the market's fear gauge. Does that mean that investors are getting spooked?
Yeah, that's a good way to think about it. The VIX essentially measures market expectations of volatility over the next 30 days.
Yeah.
So when the VIX is high, it generally signals that investors are anticipating more price swings, which can be a sign of uncertainty or even fear in the market.
Okay. So it's not necessarily a full-blown red alert, but something to watch.
Exactly. It could just mean that investors are on the lookout for significant news or events that could potentially shake things up.
Right.
It's a good reminder that markets don't move in a straight line.
Yeah.
There are always ups and downs, and sometimes those downs can be quite dramatic.
Definitely. Speaking of those ups and downs, another data point that caught my eye was the FII net open interest. They mentioned that it's positive, but lower than the previous week. Now, I know FII stands for Foreign Institutional Investors.
Yeah.
But what exactly is net open interest? And what does that tell us about investor sentiment?
So net open interest essentially measures the difference between outstanding long and short positions held by FIIs in the derivatives market.
Okay.
In simpler terms, it basically tells us how much FIIs are betting on the market's direction.
Okay. So if it's positive, that means that they're generally bullish.
Precisely. A positive net open interest suggests that FIIs, overall, are more optimistic than pessimistic. However, the fact that it's lower than the previous week might indicate that some FIIs are becoming a bit more cautious, potentially due to, those global concerns we discussed earlier.
Right. So it's not like a complete U-turn in sentiment.
Yeah.
But it is a subtle shift that we should probably pay attention to.
Yeah.
It's just another layer to this whole complex puzzle that we're putting together. Now, you know me. I always appreciate a bold statement. And this newsletter certainly does not disappoint. Some of those specific investment tips are quite something. Below 23,000 on the Nifty, convert all debt to equity. Below 22,000, buy more equity, even convert gold and FDs. It's like they've given us a financial recipe book.
Yeah, I understand why those tips caught your attention. I mean, they're very direct. However, it's crucial to remember that these are just suggestions from a single source, right?
Yeah.
They might be suitable in a particular context or for a specific investor, but they're certainly not universally applicable.
Yeah, that's a really good point. Like, just because someone, even like a seasoned expert, offers investment advice doesn't mean it's the right move for you, everyone listening.
Yeah.
Your financial decisions should always be based on your own research, your own risk tolerance, and your own unique circumstances.
Exactly.
I think that's a really good reminder. I'm curious, though, how they then shift to broader sector recommendations. They suggest focusing on banking, finance, IT, and pharma. What do you make of that?
Right. So those are some pretty significant sectors, and I don't think it's a random selection.
Right.
These sectors are often seen as kind of the engines driving the Indian economy. Banking and finance, of course, play a critical role in supporting economic growth, while IT and pharma are areas where India has established a global competitive advantage. So the newsletter might be implying that. These sectors are poised to outperform the broader market in the current economic environment.
Okay, so it's not just picking sectors out of a hat. There's some strategic thought process there. But of course, the question remains, will these sectors actually deliver on those expectations? And are there any potential risks or downsides that investors should be aware of?
Right. I mean, that's the million-dollar question, isn't it? While these sectors have strong fundamentals and growth potential, no investment is without risk.
Right.
It's important to consider factors like regulatory changes, global competition, technological advancements. That could all impact these sectors' performance.
Right. So it's not a guaranteed win. Investors need to do their due diligence and really weigh those potential rewards against the inherent risks. Now, there's another interesting section in this newsletter that we haven't discussed yet. They talk about what they call equity neutral or negative trends, and then they kind of list a bunch of dates and observations from the past few years. What is that all about?
So that section seems to be showcasing the volatility coaches of India's past predictions, highlighting instances where they correctly anticipated shifts in market sentiment.
So it's like how they're presenting their track record
So
to build credibility.
So like, hey, look, we've been right before, so trust us now.
In a way, yeah. But what I find interesting is that they also acknowledge their misses. They mention a specific instance. When they predicted a positive trend, that didn't actually materialize. It's a refreshing dose of humility and a reminder that even experienced market observers don't have a perfect crystal ball.
That's true. So even though this newsletter is packed with all this data, all these insights, and even those specific recommendations, we can't just treat it as a roadmap to guaranteed investment success.
Right. The true value lies in understanding the concepts, the tools, the analytical framework that underpin these insights. That's what empowers you to make informed decisions, regardless of what the market throws your way. I love that. It's about empowering yourself with that knowledge, those critical thinking skills, to navigate the complexities of the stock market. And speaking of navigating complexity, remember that mention of potential, equity neutral or negative trends. What signals should we be watching for in the coming weeks or even months to assess the accuracy of that prediction?
Yeah, that's a great question to ponder. I mean, it's like you're becoming your own market detective. Gathering clues, piecing together that puzzle.
Okay, I like that. So what are those clues? Where do we even start our investigation?
Well, I would say keep a close eye on those key indicators we've already talked about, the Nifty Y50's performance, the VIX FII activity, and of course, global economic developments.
Okay.
But don't stop there. Pay attention to news and events that could influence investor sentiment, both within India and on the global stage.
Right, so it's not just about crunching numbers, but it's also about staying informed about the broader economic and geopolitical landscape. It's about connecting the dots and understanding how all these factors interact. So it's like we're building our own personal market intelligence agency.
Precisely. And the more you learn, the more you analyze, the more confident you'll become in your ability to make informed investment decisions.
This deep dive has been quite a journey. We've gone from raw data to expert analysis, to global economic trends. It's amazing how much we can unpack from just one newsletter when we really delve into it.
Yeah, it's all about asking the right questions, connecting the dots, and understanding the forces at play. And, this isn't a solitary endeavor. We'd love to hear your observations and questions as well.
Yes. What stood out to you from this deep dive? Share your thoughts. Challenge our assumptions. Let's keep this conversation going beyond this episode.
That's the beauty of exploring these topics together. The more we share, the more we question, the better equipped we become to navigate this ever-changing financial landscape.
I completely agree. This deep dive wasn't about just giving you information. It was about giving you the tools to think for yourself.
Exactly. It's about empowering you to become a more informed, more discerning, and ultimately, more confident investor.
So until next time, keep those minds sharp, keep those eyes peeled for those market signals we talked about, and keep those questions coming.
Happy investing, everyone. It's all about understanding, the forces at play.
Yeah. And remember, this isn't a solitary endeavor. We'd love to hear your observations and questions as well.
Yeah.
So what stood out to you from this deep dive? Share your thoughts, challenge our assumptions. Let's keep this conversation going beyond this episode.
Yeah, for sure. I think that's the beauty of exploring these topics together, right?
Yeah.
The more we share, the more we question, the better equipped we become to navigate this ever-changing financial landscape.
That's so true. This deep dive wasn't about just giving you information. It was about giving you the tools to think for yourself.
Exactly. It's about empowering you to become a more informed, more discerning, and ultimately, more confident investor.
So until next time, keep those minds sharp, keep those eyes peeled for those market signals we talked about, and keep those questions coming.
Happy investing, everyone. It's really about, becoming part of the conversation.
Yeah. And we'd love to hear from you. What are your observations? What stood out to you from this deep dive? Share your thoughts with us.
Yeah.
Challenge our assumptions. Let's keep this conversation going.
Absolutely. I think, that's the beauty of exploring these topics together.
Yeah.
The more we share, the more we learn from each other.
Totally. This deep dive, it wasn't about us just giving you information. It was about giving you the tools to think for yourself.
Exactly.
To form your own conclusions.
That's the goal.
About empowering you to be a more informed, a more discerning, and ultimately a more confident investor.
Absolutely.
All right. Until next time, keep those minds sharp. Keep those eyes peeled for those market signals we talked about.
Yes.
And keep those questions coming.
Happy investing, everyone.